Imagine a $5,742 paycheck hitting your account monthly. Passive, consistent, and scalable. Now, what if I told you it's achievable using just 6 ETFs? Sounds crazy, right? But this isn't a dream, it's a system that works. In this video, I'll show you how I built a portfolio that pays $5,742 monthly, why most people overlook these opportunities, and the exact steps you can take to replicate it. If you want to skip the trial and error, stick around till the end, where I'll share how to fast-track your results with my Patreon. If you want passive income, you need consistency. That means dividends hitting your account month after month, regardless of what the market's doing. But here's the thing. Building that kind of income isn't about buying random stocks. It's about leverage, and the best leverage in the game, dividend ETFs. Dividend ETFs take the guesswork out of income investing. Instead of you trying to pick the perfect companies, these funds do the work for you, selecting a curated basket of high-quality, dividend-paying stocks. It's like having a team of analysts working around the clock to maximize your returns. But not all dividend ETFs are created equal. Some promise big yields but sacrifice long-term stability to deliver those payouts. That's what we call a dividend trap. The kind of fund that hands you cash on one side while losing value on the other. The result, you're getting paid, but your overall portfolio shrinks. The right dividend ETFs avoid this pitfall. They're built for stability and cash flow. Take JEPQ for example. It's an ETF that capitalizes on the growth of the NASDAQ 100 while delivering a 10.1% yield, paid monthly. Or a fund like SNSXX, which earns 4.17% by parking cash in safe income-generating assets. These funds don't just pay you, they protect your money while it grows. This is why dividend ETFs are a game changer for passive income investors. They're efficient, diversified, and designed to deliver consistent results. Instead of managing a dozen moving parts, you focus on one thing, choosing the right ETFs to build your portfolio. With the right mix, you can generate steady income without the stress of micromanaging every stock. Passive income isn't about complexity, it's about strategy. Dividend ETFs are the simplest, most effective way to create a portfolio that pays you consistently. Anything less is just unnecessary work. When it comes to dividend income, not all ETFs are created equal. Some trickle out small payments every quarter. Others, they send cash straight to your account every month like clockwork. Enter JEPQ, the undisputed king of my dividend portfolio, and here's why. JEPQ isn't just another ETF. With a 10.1% dividend yield, it's a cash flow machine designed to take advantage of the NASDAQ 100. Think of it as your ticket to turning high-growth tech stocks into steady monthly income. In December alone, JEPQ paid me $4,426. That's almost 80% of my total passive income from just one fund. Here's how it works. JEPQ uses a covered call strategy. That means it holds the same tech-heavy stocks as the Triple Q. Think Apple, Microsoft, and Amazon, but sells options against them to generate extra income. The result, you get paid whether the market's up, down, or sideways. And because it only uses 20% of its portfolio for options, it still captures tech growth while protecting against major downturns. But let's be real, JEPQ isn't perfect. If tech takes a hit, JEPQ feels it too. That's why you don't put all your money in one fund. But for aggressive income seekers, it's a no-brainer. The combination of tech exposure and monthly payouts makes it an essential piece of any high-yield strategy. Most dividend ETFs stick to quarterly payouts, but JEPQ rewrites the rulebook. With monthly income, you don't just collect dividends, you can reinvest them faster, compounding your returns over time. That's leverage, and it's what sets JEPQ apart. If you're serious about creating a reliable income stream, JEPQ deserves a top spot in your portfolio. It's not just a dividend play, it's a strategy for turning today's tech giants into tomorrow's passive income powerhouse. Now, not all of your money should be chasing big plays. Smart investors keep some of their portfolio in dry powder, cash that's ready to deploy when the right opportunity hits. But here's the problem. Cash sitting idle does nothing. That's why I use SNSXX and SWVXX. These funds keep my cash safe, liquid, and earning, so I'm always ready to strike. And here's what makes them bulletproof. They both trade at $1, always. That means there's no risk of losing your principal. SNSXX, with its 4.1% dividend yield, paid me $954.27 last month. That's nearly $1,000 in free money from cash I'm just holding. And SWV Same deal. It delivers a 4.25% yield while staying completely liquid. These funds ensure my dry powder is working while I wait for the next big move. Why is this so important? Because opportunities don't wait for you to sell stocks. Imagine the market tanks and the perfect ETF hits your buy zone. If you don't have cash ready, you're either stuck or forced to sell something else, often at the worst time. With these two, I always have dry powder ready to deploy without compromising my current investments. Here's the thing, and this is a big deal. These funds are more than placeholders. They're income generators. Every month they pay me just for parking my cash. That means I'm not only preserving my capital, but also growing it while keeping liquidity intact. They're like a financial pit stop, steady, reliable, and always ready to fuel the next leg of your portfolio's journey. If you're not using cash parking funds, you're absolutely leaving money on the table. SNS and SWVXX don't just keep your dry powder safe, they make sure it's earning until you're ready to make your next move. In investing, timing is everything, and these funds keep you ready to win. Every portfolio needs a steady hand, something you can rely on to perform, even when the market goes haywire. That's SCHD. It's not flashy and it doesn't grab headlines, but it does exactly what you need. Deliver consistent dividends from high-quality companies that stand the test of time. With a 3.78% dividend yield, SCHD might not sound like a superstar, but here's what makes it special: reliability. This ETF is built around rock-solid dividend-paying companies. Think household names with years of profitability under their belts. These are businesses that know how to weather recessions, adapt to market changes, and keep pumping out cash no matter what. That stability you can count on. Here's why I'm watching SCHD right now. It's pulled back to the 200-day EMA. For those unfamiliar, the 200-day EMA is like a gravitational pull. It often marks a critical price level where smart money steps in. Think of it as an on-sale sign for a high-quality ETF. If you've been waiting for a signal to buy, this is it. SCHD is the perfect counterbalance to a high-yield ETF like JEPQ. Where JEPQ leverages technology growth and monthly payouts, SCHD keeps things steady with quarterly dividends and a portfolio of diversified established companies. Together, they're like offense and defense. One drives aggressive income and the other ensures long-term stability. The magic of SCHD is in the compounding. Its dividends might be quarterly, but over time they snowball into a powerful income stream. Pair that with its consistent performance and you've got a fund that not only pays you, but grows with you. This isn't a flashy investment, it's a smart one. If you're building a portfolio that lasts, consider SCHD. It's not just another ETF, it's the backbone of a strategy designed to keep your income flowing while minimizing risk. And dividend income is great, but let's get one thing straight. Growth matters. Without it, you're leaving a massive chunk of potential returns on the table. That's where SMH and SCHG come in. These ETFs aren't about dividends, they're about capital appreciation, plain and simple. And if you're serious about building long-term wealth, you need growth drivers like these in your portfolio. Let's start with SMH, the semiconductor ETF. Semiconductors are the backbone of modern technology, powering everything from AI to electric vehicles. SMH doesn't just give you exposure to this high-growth sector, it's crushed it this year, up 44.37% year to date. It's not a dividend play, but that didn't stop SMH from paying me $175.69 last month. It's proof that even growth-focused ETFs can contribute to your passive goals. Then there's SCHG, a growth ETF that focuses on large-cap companies with serious upside. Think of it as your ticket to owning the Googles and Amazons of the world without betting the farm on individual stocks. Year to date, SCHG is up 41.65%, showing that growth isn't just theoretical, it's real measurable performance. And while its dividend yield is a paltry 0.35%, it's the capital appreciation that makes this ETF invaluable in a balanced portfolio. Here's a thing that very few people talk about. A portfolio built entirely on dividends might pay you today, but it won't maximize your wealth tomorrow. Growth ETFs like SMH and SCHG give you the best of both worlds. They let you capture upside in the market's promising sectors while still contributing small but meaningful dividends to your overall income stream. If you're skipping growth ETFs, you're leaving potential gains on the table. SMH and SCHG ensure your portfolio isn't just paying you, it's growing alongside you. And when you pair them with dividend powerhouses like JEPQ and SCHD, you've got a strategy that delivers income today and capital appreciation for the future. Do you want to know the easiest way to lose money with dividends? Taxes, Uncle Sam. Every dollar you pay in taxes is a dollar that's not compounding for you. That's why retirement accounts like a Roth IRA or traditional IRA are the ultimate weapon for dividend investors. They don't just help you keep more of what you earn, they supercharge your portfolio's growth over time. Let's start with the Roth IRA. This account is a no-brainer if you qualify. Why? Because every dividend you earn and every dollar of growth is 100% tax-free. Let's talk JEPQ. Its 10.1% dividend yield is a monster, but here's the catch. Those dividends aren't qualified, meaning they're taxed as ordinary income in a regular brokerage account. That could be 22, 32%, or even more. Money gone before it ever compounds. But in a Roth IRA, you keep every single cent. While the traditional IRA, while it's not tax-free like a Roth, it's still a massive advantage. Dividends and gains grow tax-deferred, meaning you don't pay taxes until you withdraw in retirement. This gives you decades of compounding without Uncle Sam taking a cut. If you're planning to reinvest dividends for growth, the traditional IRA ensures you're reinvesting the full amount, not the leftovers after taxes. Here's the deal. These accounts are especially critical for high-yield ETFs like JEPQ or cash parking funds like SNSXX. Their frequent payouts mean more opportunities for compounding, and retirement accounts eliminate the tax drag that can eat into those returns. It's a simple move that multiplies your money over time. So if you're not using a retirement account for your dividend portfolio, you're leaving serious money on the table. Whether it's a Roth IRA or a traditional IRA, these accounts are the cheat code to building passive income faster and more efficiently. Maximize your contributions, park your ETFs inside, and let time and compounding do the rest. Now, let's talk results. In December, my portfolio paid me $5,742. That's not a projection or a back test. It's real money straight into my account. And here's the best part. You don't need to reinvent the wheel to get results like this. You just need the right mix of ETFs working together. Here's the breakdown. JEPQ brought in $4,426. That's the heavy hitter, delivering the bulk of my passive income with its massive 10.1% yield. SNS added $954.27, giving me consistent returns while keeping my dry powder on standby. SCHD contributed $26.45. Not huge, but it's the stable foundation that balances the portfolio. SWVXX threw in another $40.32, keeping my cash liquid and earning. SMH added $175.69, and SCHG rounded things out with $118.97. Together, these ETFs generated nearly $6,000 in 1 month. The key here isn't just the individual ETFs, it's how they work together. JEPQ and SNS handle the heavy lifting for monthly income. SCHD adds stability with its reliable quarterly payouts. SWVXX keeps cash on hand for flexibility, and SMH and SCHG inject growth, ensuring the portfolio isn't just paying today, but growing for tomorrow. This isn't about chasing the highest yield or betting it all on one ETF. It's about balance. High yield, growth, stability, and liquidity all play a role. That's how you build a portfolio that performs in any market condition. It's not magic, it's strategy. And here's the best part. This approach scales. Whether you're starting with $10,000, $100,000, or even 7 figures, you can build a version of this portfolio that fits your goals. The key is getting started. The longer you wait, the more income and growth you leave on the table. So here's the bottom line. My portfolio paid me $5,742 in December. Over $4,426 of that came from JEPQ, proving it's the backbone of my passive income strategy. But let's be clear, this isn't a set it and forget it system. Every ETF in this portfolio plays a specific role, and together they create a machine that generates consistent income while balancing growth and risk. JEPQ is aggressive. It thrives on technology, which means if tech takes a hit, so will JEPQ. That's why SNS is my safety net, providing stability and liquidity with a 4.1% yield. SCHD is my stabilizer, adding quarterly dividends from rock-solid companies. SW keeps my cash ready and earning, while SMH and SCHG bring growth to the table, ensuring my portfolio grows alongside my income. The beauty of this strategy is its scalability. Whether you're starting small or managing six figures, you can build a version of this portfolio that works for you. But here's the thing, opportunities don't wait. Every day you're not compounding dividends is a day you're leaving money on the table. So here's my challenge. Start now. If you want to fast track your results, join my Patreon. You'll get real-time trade alerts, my top plays, and daily breakdowns of what's hot in the market. This isn't theory, it's a system I use to generate consistent income, and it's working. If you're serious about leveling up your investing, don't wait. The tools, strategies, and insights are right in front of you. It's time to build your portfolio, grow your income, and take control of your financial future. Peace, and I'll see you on the next video.